Hello, guys, and welcome to this week's edition of the ITU Forex class. In this week's episode, we're going to be talking about how to trade with Fibonacci retracement. Okay, so if you've been trading in the Forex markets, or if you've been involved in the Forex markets for any considerable length of time, I'm pretty sure you must have come across the Fibonacci retracement tool. Okay, and some of you might know how to use it, some of you might not, but by the end of this class, the lesson you're going to learn about how to use Fibonacci retracements is going to help you to pinpoint or to find better trade entries, okay, for whichever trading strategy or trading methodology you choose to use. But one thing you need to know before we even kick off the class is that Fibonacci retracements, okay, they are only going to work well when there's a trending market. Okay, I'm going to explain this to you in depth, but you need to understand. You just need to have it at the back of your mind that whatever we're going to be learning today with regards to Fibonacci retracements, you shouldn't just pick what you learned today and try to apply it to a market which is ranging. Okay, when I say a ranging market, I simply mean a market which is let me draw it like this. When I say a ranging market, I simply mean a market which is bouncing in between levels of horizontal support and resistance. It might not be as clean as this, and you might have a little bit of a price, maybe not being unable to reach resistance areas or even breaking below support areas because it's just a zone. Okay, so when we talk about Fibonacci retracements, know that this particular tool is going to give you the best results, better results when you use them during market conditions which are trending in nature. Okay, so with that out of the way, let's talk about what we're going to be talking about in this week's edition of the ITU Forex class, which is how to use Fibonacci retracements to pinpoint better trade entries. Okay, but before we can do that, we first need to even know what Fibonacci retracements are. Okay, so this is not a science class, and I know that if I was trying to explain science things to you because you came to learn about trading, that's going to bore you to death. Okay, so we're just going to brush over what Fibonacci numbers are, and you can do a quick research or a quick read on blogs or whatever on Google when you search for Fibonacci sequence. The idea is that there's a particular sequence of numbers, okay, and they start with, for the Fibonacci sequence of numbers, usually they start with 0, and then the idea is that the next number you're going to get after 0, when you have the number 1 in the sequence, you're going to add 0 and 1, and it's going to give you the next number in the sequence. And then you do the same thing again. 1 plus the next number in the sequence is going to be 2. You keep doing this, if I'm not mistaken. This is how you come about the Fibonacci sequence of numbers. And then after understanding how the Fibonacci sequence of numbers are, a lot of there's this Italian scientist who is known as Leonardo Fibonacci. Okay, he worked out the sequence of numbers and also found that there's between the ratios, okay, the relationship between the numbers which are adjacent to each other, there's kind of like a ratio which he found, which is also a sequence in and of itself. And when he did a little bit of digging and research and all of that, he found that those numbers occur in nature naturally. Okay, from the spirals of a snail shell, to a lot of things that he saw in nature, where those numbers or those sequence of numbers or the ratios appear in nature. Okay, so that's the significance that we're given to the numbers. You can see it's being applied in engineering, in medicine, even in the the anatomy of the human body and all of that. So that's kind of like the gist of it. So what does that have to do with anything trading related? Okay, the idea is that some traders in the past found that since the Fibonacci sequence of numbers occurs in human nature, and since trading is basically people interacting with each other, it's mass psychology that we're seeing, which is represented by the expression of people on particular financial instruments about what it's going to do. What they found is, since human nature is also inherently imminent in the market, then the Fibonacci numbers or set of numbers should also have significance within that market. And that was how the whole sequence of, okay, using the retracements, or which are simply the ratios between the Fibonacci sequence of numbers, came about, because they found that, in the movement of a market, remember we talked about market structure for the past couple of weeks now, and we talked about the three phases that the market can exist in. The first is a trending market phase, where if it's in an uptrending market, you're going to have price forming higher highs and higher lows, higher highs and higher lows. While if the market is in a downtrend, it's going to be forming lower lows and lower highs, something like this, okay? This is the trending market phase. The next one after the trending market phase is number 2, the ranging market phase, okay, which is what we have here, where you have price bouncing in between levels of horizontal support and resistance, okay? And then last but not least, we have the consolidation market phase, where there's decreasing volume in the markets, and so triangles are being formed because basically price is finding it difficult to expand, okay? So what was found is that when the market is in a trending phase, usually it's not going to move up in a straight line. Remember, we did this in the past couple of classes. We said that if a market is in an uptrend, it's usually going to move up and then it will pull back a little bit. Not all the way down to the origin point where that move began. It's going to just pull back a little bit, okay? As long as that trend is strong and as long as that trend is healthy, it's just going to pull back slightly, okay? It might pull all the way back down here, but the deeper that pullback is, the weaker the trend is, okay? So the idea is that if the trend is strong, the pullback should be as shallow as possible before the market now resumes to break above, resistance areas and continue moving in the direction of the prevalent trend. So if the market is in an uptrend, then it should pull back, now just make a shallow pullback and then pull back again and break above the resistance that we had here, then continue forming higher highs and higher lows. So if we were to label this, this would be our high, or let me quickly take this off, just cancel this. This would be our high, this was our low, okay, the origin point. Now this low, when you compare it to this previous low, this would be HL, higher low. While this high, when you compare it to the previous high, is going to be HH, which is higher high, okay? So we have the formation of higher highs, higher lows, higher highs, and higher lows. Now, since I told you that when you divide the first number in the Fibonacci sequence with the second number, or the first number with the third, or whatever, there's kind of like a constant ratio between the sequence of numbers in the Fibonacci sequence. You don't need to know that. You don't need to do all of these calculations manually. In fact, most of the trading packages, trading tools, or platforms that are out there, they would calculate these numbers for you automatically when you're using the Fibonacci retracement tool. I'm just trying to explain it to you because there's a magical thing about understanding the logic behind the tools you're using. So if you understand how the Fibonacci retracement tool, calculates all of those random lines that it's adding to your chart when you choose to use it, it's going to make you appreciate how to use it better, okay? So basically, what the Fibonacci retracement tool does is, when you add it to a chart, you don't just randomly add it to a price chart. The idea is that if a market is in an uptrend, okay, since it's going to be forming higher highs and higher lows, what you want to do is you want to connect the lowest point of an impulse wave. So if the market is in an uptrend, an impulse wave will be a wave that moves up in the direction of the trend, okay? So from this low to this high point, these are the two levels, these are the two areas that you're going to draw your Fibonacci retracement using, okay? So you select the lowest point of this move, that's this retracement, this extension move, or this impulsive move, and then you would draw your Fibonacci retracement from all the way down here to all the way up here where the move stalled, or where the pullback began. The idea is that since Fibonacci ratios, we've got the 23.6%, we've got the 38.2%, we've got the 50.0%, we've got the, if I'm not mistaken, the 76.8%, and all of that. The idea is that when you draw your Fibonacci retracement tool, is going to draw lines breaking this move. So if this move was a 100 pip move, this tool, the Fibonacci retracement tool, is going to break this 100 pips move into 23.6% of that move, then 38.8% of that move, 50% of that move, 76.8% of that move. All is going to break them down. And the idea is that the way you use it is, after you draw the Fibonacci retracement using the lowest point of the tool and the highest point of this move, the impulsive move, you're going to keep your eyes open for where price is likely going to stop its pullback and then continue moving in the direction of the trend. And it's likely going to be doing that at any one of these Fibonacci retracement areas. That's just what this is. Okay? Now, explaining it like this for you without showing it on the chart is going to be a little tricky for you to understand. And that's the reason why we're going to move on to the charts now, because if I show this to you on the charts using a live example, it's going to make it a lot easier for you to understand. So let's do that. Okay, moving on. So what you are seeing on my chart now is, on my screen, sorry, is a price chart of any currency pair. It doesn't matter, okay? But this particular one is the GBP JPY currency pair, and this is the 4-hour time frame. Okay, so what do you see on this chart? Now that you're just looking at the chart, what do you see? If you've been attending any of our previous classes, especially the ones on market structure and all of that, and price action, you'd know that this market is in an uptrend. Okay, there's no doubt about it. This market is in an uptrend. And why do I say this market is in an uptrend? What's my reason for saying this? The reason for saying that this market is in an uptrend is pretty simple. If you take a close look at the chart, you'd notice that price has been forming higher highs and higher lows. Higher highs, higher lows. Higher highs, higher lows. Higher highs, higher lows. And what market structure is this? This particular type of market structure that I just showed you now, when does it occur in the market? Does it occur when the market is trending, or does it occur when the market is consolidating or ranging? It occurs when the market is trending, obviously. And the particular type of trend is an uptrending market condition, okay? Because price is breaking above resistance areas to form brand new highs, and it's struggling, finding it very hard to test previous lows. In fact, it doesn't come all the way down to the previous low. It just comes very close to it, and then it reverses and continue moving in the direction of the prevalent trend, okay? Now, with this in mind, this should tell you something about how we're going to be using the Fibonacci retracement tool already. Because the idea is that the moves that move from lows to break above resistance to form brand new highs, these are called impulse moves or impulse waves. While the moves which stop when the impulse wave ends and then it pulls back or it corrects, okay, the impulse waves move is known as the corrective wave, okay, or retracement, okay. Now, basically, when you're using the Fibonacci retracement tool, you're basically trying to trade a trend following trading strategy, but you're doing that in such a way that you're waiting for pullbacks to occur. It's not like a breakout trading strategy where you know that the market is in an uptrend, and so you place your buy stop pending order at the high of the previous move where it stalled, so that if the market wants to continue moving in the direction of the move, it's going to, when it breaks above the resistance, you're going to have a buy trade, and then your stop loss is going to be somewhere below the higher low that price couldn't even test, okay? And then you're just going to take that trade with proper risk management, of course. When you're trading with the Fibonacci retracement tool, the idea is that you are waiting for the market to make a pullback to any one of those levels that Fibonacci retracement levels, or the ratios, the percentage levels, and then you're going to keep a close eye on how price reacts to those levels, because the idea is that price is likely going to stall along within one of those levels before it continues moving in the direction of the trend. So you are using the Fibonacci retracement tool to identify the levels, the price levels where price is likely going to stop its correction or stop its retracement, and then continue moving in the direction of the trend. Okay? So for example, you can see that this particular move, like I told you, price started moving from all the way down here, from this low, and then it formed this high, and then it pulled back. But then this pullback was not as, it wasn't able to go below this low. And so for some reason, price is respecting this low, which is the reason why this particular low is higher than this previous low. So price is now forming a higher low. If you were to use, since you've already seen that price is struggling to break above, below this area, if you were to use the Fibonacci retracement tool to identify when to trade or when to time your entries for this particular move, what you do is you'd need to pick the tool, and I have them as a shortcut here. So if you want to use them if you're using TradingView, just click on here and then select it from anywhere from here. Okay, you're going to see the Fib retracement tool. So just select it from here. Okay, I have it here because I actually just sorry, I'm drawing it somewhere here. I'm looking for the tool for you here because I just have it as a shortcut to make it easy. This is where you'd find it. You see Fib retracement. Okay, so if you were to use the Fib retracement tool, you would actually draw from this low to this high. Okay, and then you see these were the levels that I was telling you about. So the idea is that this move, this impulsive move, has been broken down based on Fibonacci ratios. So this move, this is 23.6% of this whole move, this impulsive move, from this low to this high. So this is 23.6% of that move. Now, you don't just draw this move and say, okay, since price came all the way down here, is at the 23. This is the mistake that a lot of Fibonacci traders make. What they do is they will draw this Fibonacci retracement tool, and then as soon as price comes to any one of these levels, they'll just place a trade blindly. This is not how to use Fibonacci retracement to time your entries. The best way to use it is for you to draw the retracement, that's using your impulsive wave, and then keep your eyes open for how price reacts to these Fibonacci levels, these retracement levels. So for this particular example that we're using, if you had drawn from this low to this high, and then the tool was showing you these Fibonacci retracement zones. So this 23.6 level, 38.2 level, 50% level, 61.8, 78.6, and obviously 100% of the move, because this was where you started. You would keep your eyes open for how price reacts to this area. So you want to buy, obviously, because if you are using the Fibonacci retracement tool when the market is in an uptrend, you are waiting for a pullback of that uptrending move so that you can get into the market with a trade and then ride that wave, ride that trend. So when you see these strong red candles, which just pierced through the 23.6 level, the 38.2 level, the 50.0 Fibonacci level, as if it wasn't even there, will you bother to buy? Of course not. Because you are using your mind, you are using your senses, okay, to actually see how price is reacting to these levels. So if you don't have the formation of a bullish engulfing candlestick or anything that is signaling to you that the bears might be weak and the bulls are stepping in, you have absolutely no reason to buy that currency pair. So you shouldn't just use the Fibonacci retracement tool like most traders who don't know how to use the tool properly are doing. They'll just use the impulsive wave, draw from the highs, from the lows to the highs during an uptrending market, or from the highs to the lows during a downtrending market, and then once price reaches one of these Fibonacci levels, like the 50% level or the 38.2 or 61.8, they will just simply buy, because the idea is price came to this level and it's going, because it's the Fibonacci level, it's going to react. That's not how it works. Price can do whatever it wants to do, whether a Fibonacci level is there or is not. Okay? And that's the reason why you wait to see how price reacts to this level. Do we have the formation of a bullish engulfing candlestick? Do we have something like a W pattern for an uptrending market, or an M pattern for a downtrending market, and all of these things? Now, with this in mind, when I zoom in a little bit on this particular example trade setup that we are talking about, you can see that when price came all the way to the 61.8 level, it started finding it difficult to continue moving to the downside. And so here, if I just take this off a little bit to the side, or let me zoom in like this so that you can see exactly what I'm talking about. You can see that even though this candle was a bullish candlestick, it wasn't kind of like a bullish engulfing candlestick, because for it to be a bullish engulfing candlestick, the body of the green candlestick needs to completely engulf this red candlestick, which didn't happen. This is more like 70% of the body of the candlestick, the red candlestick. So this is not a signal that the bulls have stepped in strong, okay? But then when price tried to continue moving up, you can see that we have weakness here, because this candlestick is kind of like a doji here. Is showing us indecision on both the side of the bulls and the bears. The reason why I'm taking my time to explain this to you is because this is the proper way to use Fibonacci retracements to identify trade entry levels, low risk, high probability trade entry levels. A lot of traders who use this, especially amateurs, they just feel that when they draw the Fibonacci retracement tool, when price comes to 50% retracement or 61, they just buy or they just sell because it's a Fibonacci retracement level and price must do what the Fibonacci retracement tool wants it to do. That's not how it works. In this market, nothing is absolute. Price is the king. Price can do whatever it wants to do. Whatever it wants to do, regardless of what confluence you're seeing or what is happening on the charts. Okay? So you can see that when we had this is showing us that, okay, it looks like the bulls are not that strong anymore. And then we had this strong move to the downside. But then immediately after that, price got rejected at this 78.6 Fibonacci retracement level. And this is a very deep retracement. So what is this telling us? This is telling us that even though we have something like a bullish move, because this is an impulsive wave, and then price is forming what appears to be a higher low, because it's finding it couldn't just come here to break below this low and continue moving down. This particular uptrend is still weak, because in a strong uptrending market, price has no business whatsoever to make a pullback or a retracement which is this deep, okay, which should come to 50% of the Fibonacci retracement level. Talk more of 78.60, okay? And so even if you were to take this trade, you should take it with caution, just like any other trade you take, because when I say caution, I mean do proper risk management, okay? Because even if everything aligned, there's still a possibility that price can do what you didn't expect it to do, okay? So in this case, you can see that after this strong bearish move, price immediately bounced back up. So this could have been a trade setup for you, in the sense that when you saw this bounce up and you know that price is struggling to break below this level, you can say that, okay, you know what, since the market is in an uptrend, if price for whatever reason breaks above the high of this bearish engulfing candlestick, then this is a cue, this is a signal for us that this uptrend is likely going to continue. And if this uptrend is going to continue, then this previous high is most likely going to get broken. Okay, and so because we're going to have the formation of a brand new high, since in a trending market, in an uptrending market, price is going to be forming higher highs and higher lows. So for you to take this trade setup, you place your buy stop and pending order at the high of this particular bearish engulfing candlestick, because if price is able to break above this is showing us that it looks like price is going to continue, and your stop loss will be placed below this low. Why is this so? The reason is simply because if for whatever reason after we take this trade, price decides to reverse against us and go all the way down here to break below this level, then this is no longer an uptrending market, because in an uptrending market, price is supposed to be forming higher highs and higher lows. And if for whatever reason after our trade gets triggered, price is able to come all the way down here, then this is not a higher low, it's actually a lower low. So we are no longer in an uptrend and we're not interested in taking this trade. And the final piece of the puzzle is for us to practice proper risk management, which is risk no more than 1% of your trading account's capital per trade. And if you are doing that, your risk management, there's also another aspect to it, which is your risk to reward ratio. So if you're risking 1, you want to make 2. The reason is because if you're always risking 1 to make 2, even if you won 50% of the trades you took and lost 50% of the trades you took, you're going to end up being profitable, because the profits from your winning trades outweigh the losses from your losing trades. So if we took this trade here and our stop loss was here, our profit target will be placed 2 times what we're risking here. So it will be somewhere around here. And you can see that for this particular trade setup, price would have easily, easily hit our profit target here. Okay? This is simply how you use this Fibonacci retracement to trade this market. Okay? So this is an example using this particular impulsive wave. But there's also another wave. So let's assume you missed this particular trade setup. Okay? Let's assume you missed it. Well, if you missed it, let's clean up everything that we have on our charts here and look for the next example that I will show you. Remember, this market is in an uptrend. Why do I say it's in an uptrend? It's because it's forming higher highs and higher lows. Higher highs and higher lows. Remember, higher highs and higher lows. But when all of this was happening, this price action hadn't happened yet. So the idea is that if you wanted to trade this Fibonacci retracement because you saw price forming these higher highs and higher lows, but then you missed this particular entry, then you should know that this particular move also is an impulsive wave. Why do I say that this move is an impulsive wave? The reason is simply because when you look at this, since we appear to be in an uptrend, price is forming higher highs and higher lows. Okay? This high is actually higher than this previous high, even though this high is just slightly higher than this previous high. So in this case, this is an impulse wave. And what do we do when we want to trade with Fibonacci retracement? We are going to draw our Fibonacci retracement using the impulse wave. So if it's an uptrending market, we'll draw from the low of the move to the high of the move, and opposite for a downtrending market. So in this case, after we drew this impulsive wave, remember we've drawn this wave now. What are we waiting for? I told you the amateur traders will draw this wave, and then they'll tell you that their guru says when you have a 50% Fibonacci retracement, anytime the price comes there, just buy. Paying no attention to how price is reacting to that level. That's not how we trade with Fibonacci retracements. We trade professionally. And so the way we do it is, after we've drawn our Fibonacci retracement, we will now fold our hands and watch how price is reacting to these Fibonacci retracement levels. How is it reacting to the 23.6 level? You can see that this strong red candlestick just blew past that level like it wasn't even there. So do we have any reason after seeing this strong red candlestick to buy? Well, of course we don't have any reason, because there's no reason in the market that is telling us that the bulls have stepped into the market and giving us a indication to buy. But then when price came to the 61.8 level, we have what appears to be a reason for us to buy. What is the reason here? The reason is, you can see that this is a bullish engulfing candlestick, because the body of this green candlestick completely engulfs the body of this red candlestick. So this would have been our trade entry. So now how do we trade this? The way we trade this is we'll get into the market at the close of this candlestick, because this is a bullish engulfing candlestick, showing us that the buyers have stepped in and they have overpowered the sellers. And where is our stop loss going to be? Our stop loss is going to be placed below this low. Why? Because this is our higher low. Remember, in an uptrending market, price is going to be forming higher highs and higher lows, higher highs and higher lows. If this is truly an uptrending market, then price has no reason whatsoever to come all the way down here to break this below this low. If it does that, after we enter into this trade, we are no longer interested in the trade. We'll just take our 1% loss and call it a day. Okay, so this is the reason why our stop loss is placed here. And then we're practicing proper risk management. We're risking 1% of our account capital per trade, and we're aiming to make a profit which is 2 times what we're risking. So for this particular example, 2 times what we're risking, this is where our profit target will be. So if we move a little bit to the right, what would this trade have been? You see, this is also another winning trade. This is also another winning trade. Now, I've shown you winning trade examples in this particular lesson, in this particular class. But does that mean that we don't get losses at all when we're using this trading methodology? Of course not. And if you've been following along, if you've been following this class as well, you know that this is the reason why I always emphasize proper risk management to you. Because if you risk just a small portion of your trading account capital per trade, you would survive and live to fight another day, even if you have a losing streak, like maybe 5 or 10 losing trades in a row. And then when you have just half of those trades hitting your profit target, assuming you're trading with good risk to reward ratios, maybe you're risking 1 to make 2, or you're risking 1 to make 3, then the profits that you make from your winning trades will more than cover for the losses that you incur on your losing trades, even if you have more losses than winners. And that's how this game is won, guys. That's how trading is done. Okay, so before we wrap up the class, I would like to use this opportunity again to remind you guys that we at iTradeUp Global offer trading services, offer trading tools, okay, which are designed to help trade on your behalf. So as you may know, the ITU Forex classes, we teach you how to trade with manual trading techniques, things like this, okay? How to use the Fibonacci retracement, how to do proper risk management, how to do all of these things with manual trading techniques, okay? So while you learn how to perfect your trading skills using these manual trading techniques, we also have a portion of our company which is designed to help you take advantage of automated trading strategies to improve your trading performance and improve your profits, okay? So if you're interested in that, please reach out to us on the socials, and we'll be more than happy to assist you set everything up and get you up and running in no time. So if you're interested, reach out to us so that you can start earning while you're learning how to trade and diversify a portion of your portfolio to automated trading, as well as diversify with some of your portfolio to manual trading, okay? So I really appreciate you guys taking time out of your busy schedules to come to this class, and I hope that what you learned in this class is more than, it's going to help you to improve your trading strategies, your performance and all of that, okay? To become a profitable trader who can successfully live off of trading profits, okay? So I look forward to seeing you guys in next week's edition of the class. Until then, have a wonderful rest of your trading week. Go out there and crush the markets, okay? Thank you, and cheers.